A major shift is taking shape in the U.S. oil and gas industry. Oil giants ExxonMobil and Chevron are facing shareholder rebellions led by climate activists over the company's perceived failures to set a clear business strategy for a low carbon future. We spoke to Danielle Fugere, president of As You Sow, to learn what's next after Chevron shareholders in May backed proposals for further emission cuts. What was the significance of the votes at Chevron for you?
With our votes, shareholders were very clear that if you're an executive and you're not moving in the right direction, you're not paying attention to climate, you're not reducing your emissions, investors will be moving their money elsewhere. Investors will be knocking at your door to talk about that.
Do you see oil executives, willfully moving towards this new energy transition, or do you kind of have to drag them towards making these decisions to have a plan for the energy transition?
Well, last year was a significant year in terms of the votes and the Exxon drive to bring new and different investors onto the board. Well, it was because the company has not been responsive to shareholders on the energy transition. There's been multiple shareholder votes that the company ignored. And so investors said, if you are ignoring us, we will go to the board, whose job it is to be responsive to shareholders, and we'll switch that board out. And so I think that those significant majority votes on climate, that's a shot across the bow to executives that they have to be paying attention, because shareholders are very concerned about these issues.
So why is it so important for companies to kind of have a plan in the face of this energy transition and in the face of climate change?
One, that they're contributing to climate change. So we want companies to start transitioning their emissions downward so that they're not contributing to climate change. Two, technology is rapidly changing. So as we recognize the need to move to a net zero economy, technologies are being developed. And that means that if you're a company and you're reliant on technology that's high in carbon, a new business that's investing in clean technology is likely to be much more successful than you are. So we want companies to reduce their risk, to understand that the world and the regulation is changing, that capital will get more difficult to obtain and will be more costly if a company's not changing. And so all of these factors are merging together as they should be, and companies that are responsive will be the most successful. They'll have the highest share value.
Do you have any ideas on how U.S. independent producers can adapt possibly away from oil and gas?
We're not saying that companies have to move away entirely from oil and gas. If you look at the IEA net zero transition scenario, oil production declines by 75%, gas by 55%. So there's still markets for gas, and there's still room for production of oil, but not every producer is going to be able to produce. And so that's really the question: who will be most efficient? Many of these companies are investing in shale, which they're able to turn the pumps on and off more readily than an offshore oil production unit. So we're not saying stop doing what you're doing, but tell us how you're going to do it in a world that is transitioning away. So if we look at all of the major car companies are talking about their EV fleets, they're transitioning away from internal combustion engines to EV fleets, 100%. What does that mean for oil and gas companies? You can't just put your head in the sand. You have to understand that the world is changing, and it may be that you invest in carbon capture. It may be that you just produce a few resources. You maybe give more capital back to shareholders. There's a range of responses.
Are you looking at any companies outside of oil and gas?
All industries. We're looking at steel, we're looking at technology companies, we're looking at healthcare. Every company needs a net zero transition plan, because if every company is reducing its own emissions, that means we're much more likely to get there. And so it's not simply looking at oil and gas companies. Every company in their supply chain, whether you're agriculture or you're Google, it doesn't matter. Everybody has emissions, and everybody has to figure out how to reduce those emissions.
For its part, Chevron has said it is taking action to advance a lower carbon future and is focused on investing in high return projects and operating in a cost-effective manner. What else would you like to see accomplished at Big Oil?
We're asking Big Oil to transition, to say, what does it mean for them to be an oil and gas company in a world that is moving away from carbon? So will they become Energy providers of clean energy, will they simply be investing in higher value projects? Will they be winding down the company? There's a whole range of responses a company can have. But what we do want to know is that these oil and gas companies are reading the tea leaves and saying, yes, the world is moving away from carbon, and this is how we're going to do it. What we don't want to do is have a disorderly transition. And we've seen that before, where markets go along, and then suddenly the bottom falls out and companies fail. This is what investors want to avoid. So that was part of the message to Chevron and Exxon this year. You have to take climate change seriously.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.